All right, in this section, I want to talk about common problems that you might have in your financials. And the ones that I tend to see revolve around inventory, accounts receivable, and gross profit. Certainly, there are other issues that can pop up, but these tend to be the biggest and the most nefarious ones. So we want to keep an eye out for them. So inventory, what are the problems that happen with inventory? Usually, frankly, the inventory is wrong. The count is not physically what does not agree to the system. So something happened to the inventory. Either we picked the wrong product, we didn't receive it properly, we had breakage that we didn't record, our return to warehouse process on our trucks is incomplete or not as diligent as it should be. There's all sorts of different ways. We call these sort of leaks in the bucket, and there's typically 4 to 5 things that just have to be tightened up, and those are generally the things that I just mentioned. But the other thing you can do, and really should do on a regular basis, is have a process to count and reconcile your inventory. You can use cycle counts, you can use full physical accounts. Either one will work provided you have a good process. My recommendation is a cycle count, and to do it on a regular basis. Weekly is great, and what this does, much like your cash flow management, when you're looking at it on a regular basis, you make it part of your day-to-day. We call these sort of activities of daily living, good financial hygiene. So if you're counting on a regular basis, it just ingrains the importance of that count in your day-to-day activities. And I think cycle counts can do that. Furthermore, it breaks down a really big task into smaller chunks. Like a full physical count of all of your warehouse and this and that can be pretty tough. The last thing I'll leave you here is, kegs and pallets, for some reason, tend not to be treated the same as product inventory. If it's a case of beer, we're gonna protect that with our life. But kegs and pallets, even though we may have paid a deposit on those, tend not to be treated the same way. So we really want to have a good system to count and reconcile those as well, because they're real dollars. Accounts receivable is the other area we tend to have problems, and the issue here, this varies state to state depending on your rules. If you're in a COD state and you don't have much for accounts receivable, then I applaud you. That's a wonderful thing. If you're in a state where maybe it's 30 or 60-day terms, it gets a lot harder. And furthermore, if you're selling what I guess I would say non-regulated products, like non-alcohol products, snacks, things of that nature, you're kind of on your own. And the nature of those retailers might lend itself to slower paying. So it really puts an emphasis on accounts receivable. So the best practice here is to read and review the aging report. This is going to show you all the information you need. So it's a listing of all the people that owe you money and the age of those invoices. How old are they? Are they overdue? So it'll help you identify those collection issues and give you some opportunities to speed up collections. Now, there's lots of ways that you can use tools like FinTech. There's another app out there that's really good that's called Melio, Melio. You can check that out to just speed up the payment. So it puts people more on you're not chasing people down, they're just paying. Last thing I'd say on accounts receivable is, customer accounts receivable is one thing, supplier accounts receivable is another, so it should really be treated the same way. You should have an aging report for your supplier AR. You want to read and review it on a regular basis. You want to identify and chase down any collection problems that you may have before they become bad debts. Gross profit is the third common problem that we tend to see. What happens most often, and I would encourage folks listening to try this for yourself, take your financial statements and run a trend analysis. So what that means is you would take your income statement, sales, cost of goods, and gross profit, and run it, say, for the last 6 to 12 months, and do it on a monthly basis so you can see January, February, March, every month, and see what the trend looks like, and see if you've got some volatility or variability or inconsistency from month to month in your margins. What we might see, and what's an indicator of a problem, is in January your margin was 34%. In February your margin was 18%. In March, your margin was 29%, and then in April it goes down to, say, 12%. So you get this sort of up and down weirdness that's going on. So that's going to be an indicator, most likely, of a problem within your cost of goods sold, and that will trace you back to inventory. So it could be a pricing problem, it could be a costing problem, it could be you have too much inventory, it could be any number of things. But the trend analysis is going to at least identify, do I have a problem here? It's a quick way to see that. Next is, and this is what we typically will see wholesalers doing a really good job of, is running those gross profit reports by supplier, brand, and package, and then having an expectation for what those gross profit numbers should look like by supplier, brand, and package. So when you're reviewing those, you have a pretty good sense as to, this supplier's out of spec, what's going on, or this brand or this particular package. So it's really just a way to kind of dig in and determine if you have any issues in your gross profit area. And these reports are a great way to do that. All right, so there's a listing of problems that can kind of creep in. Now I want to take kind of a hard right turn and talk about financial planning and forecasting and best practices. So the first step I find useful is really just to kind of plan this out. Think about, when do you want to start your planning process? What team is going to be, who's going to be included in this? What are you asking people to do? And what are the deadlines for which you want them to complete their tasks? And like anything, we want to break this large budget or financial forecast down into its component parts: sales and cost of goods, operating expenses by department, capital expenses, and debt planning. And I think the easiest way to do that, or what I found is the most organized, is simply have a budget prep outline. So it can look like this, and this I'll have in the downloads for you as well. But when do you want your first draft to be completed, a second draft, and then the final plan? And then what are you asking each of your respective leaders to do, provided you've broken this into components and you're pulling different people into it. For your sales plan, for example, let's say you're having your sales manager, and what are you asking them to do? In this case, we might say, well, we want to forecast the remainder of the current year out by month, sort of high level. So if we're doing this, say, in October, what does October, November, December look like for the balance of the current year? And then let's forecast out the new year by month and show them historical numbers and trends and changes. And you might use VIP or Encompass or another software to capture and get that granular data. You may have market data and other financial information, providing sales forecast templates. So it's really like, where am I going to get all this information? What tools should I use? How do I organize it? So there's some education and training involved, and a budget prep outline like this can really help you communicate that information and keep everybody on track in terms of what you need them to do and when you need the work to be completed.